But the reason why we sell puts and calls, which are the options, and not buy puts and calls, is that the odds of success is far greater. But the opportunity for profit is far greater in buying a call or a put. So and we're going to try to use this as being an easy math. And we're just going to try to stick with Nike because I know Nike is at about $75. So if I bought a call from Nike, let's say at 78, with an option expiration date of July 15th. And if Nike goes above, and let's say I paid $1, and so Nike goes above $78, then let's say it goes to $85. That means my option is in the money by $7. And if I bought it for $1, that means I would have had to buy that option for $1,000. And so now that means I would be up $7,000 if it was at 85. So then at that point, I can either sell my option or I can exercise the option. But most people today, they're only buying the options. They don't plan on buying the shares, individual investors, because a lot of people don't, do it for that reason. But so you say, well, why would you only sell calls and sell puts and not buy calls and buy puts? If I if you buy the call using a Nike at 75 and buying the strike price at 78, if it doesn't go above 78, options do what they call deteriorate. So every day that an option is trading is deteriorating if the price don't go up, because the option is worthless if it doesn't go above 78, which is why I sell options. So if the price is at 75 and I sell the 78 strike and I get the premium of the dollar that the person bought it from, so now I have the $1,000 in my pocket, and now I now have the right to sell my shares at 78. So I always say it's you're winning, no matter what. If the stock is at $75, um I had 10 options, which is $1,000. I sold the 10 options. I got the $1,000 in. And if it goes above 78, I'm still winning because I had 1,000 shares, and it goes above 78. I'm up $3,000 on selling it. And if you watch some of our past videos, we don't really allow our options to go in the money. We do what we call repositioning. We roll up, we roll out. So we try not to sell our shares, and we do what we can to try not to sell our shares. In every last one of these trades that I'm talking about, we're always making money. It's the same thing on the put side. So if Nike is at 75 and I sell the $72 put, then and we're going to use 10 options, and I sell that option for $1 again, that means I get the premium of $1,000. And if the stock falls below the $72 price, then that means I have to purchase their share. So if it fell to 70, then without doing any repositioning or anything like that, that'll give the person the that'll give the person the right to sell me to shares at $72 when the price is at 70, which means I would be down $2,000. But like I said, we reposition, we roll out, and if we was assigned the shares, and we only do stocks that we like, which we will get into here in a minute. But now that I bought it at 72 and it's at 70, I can do several things where I can hold on to it. At 70, I can start turning around and selling calls at 72, which is the price I was assigned at. So I'm always consistently making money, and it will still be making money. So why don't more people sell options? Why is there more people that buy options? Um, Everybody's looking for the big bang. They want to be able to turn a $500 trade into $20,000, and you're not going to do this selling options. What you're going to do selling options is, you're going to make a $50 here, $100 there, depending on how much money you got and how much risk you're willing to take. You make $50 here, $100 there, but you can do that consistently over time. So like I said, if the stock is at 75 and I sold the $72 put, the only way for me to lose is the stock has to go down, and I'm still not losing because I got the opportunity to buy the shares. I got the opportunity to reposition and go from take my option from 72 to 69. There's a lot of things that I still can do with my option. But if I bought the $72 put, only thing I can do is hope that it goes below 72 and above the price of how much I paid. So if I bought it for $1, if it goes to 71, I'm only at break even. I needed to go to 71 and below. And I believe the only way really to consistently be successful at buying and selling cars is to have inside information, and that's illegal. So if I sell them consistently, like I may not get the $15,000, $20,000 win, but I'm consistently bringing in 50, 100, 150, 50. And I can do that consistently. And when you're talking weekly options, you can do it weekly. On the S&P 500, they got the SPY, you can do it daily. The SPY options and the QQQ options are daily. So you can make this money consistently every day selling options. And as long as you have, the right assets, it's really hard to lose. So how can you lose? There's two ways to really kind to lose. One of them you're not really losing. The other one you can lose. And that's picking the wrong asset. So you have to have a strong idea on how to buy stocks or if you just go with index funds. And you gotta I'm a value investor. I'm not a momentum investor or a technical investor. I'm a value investor. So the stocks that I sell options on at the price that I sell the option at, I'm kind of willing to let the shares go, even though we're going to do some repositioning, rolling it out, rolling it up for calls, for stocks that I like. But if I let it go at the price, like I have Google right now, and this is about no, I'm sorry, I have Amazon right now, and it's about 198. And I had to roll out repositioning, and I made a video on this a couple days ago. I had to roll out, so I got it at 220 with the August 2nd. So if Amazon is at 220 at August 2nd, as it gets close to 220, I can do several things. But if it blows through it, let's say on earnings day, for some reason Amazon is up 40 points and now it's at 240. I can probably roll it out, but I probably won't be able to roll it up because it's so deep in the money. But I would have sold at 220. I'm willing to sell my Amazon shares because to me that's pretty high. That's a really big increase. And then when I sell the shares, I can't have the right to come back and repurchase the shares with the hopes that I can get it below 220. So you're still not losing, but if you look at the upside that it went to 240, you'll be missing out on that run from 220 to 240. But as a value investor, there's always something for sale and there's always something to buy. And you got to know what price you're willing to pay and what price you're willing to sell. So on the opposite side, now the way that you can really lose is if you pick the wrong asset and you sell puts against it. Let's say, there's lots of stocks out there that have dropped a lot. Let's take Time Warner when it was at 24. If you start selling the 23, 22 put and Time Warner started to fall, Time Warner's at like $7 now. And let's say it went to 15 and you wasn't able to reposition the trade. And so you had to purchase it at 15. Now your stock will be at 7. I would hope that you really like it. I mean, we've made videos. We really liked Warner Brothers Discovery at one time. But we think they have a difficult situation and they're going to have a hard time, we believe, in the future. So it's a stock that we would not own or that we wouldn't buy new shares of because we own it. And we're going to ride it out and we're going to believe that they can turn it around. But that's the way that you lose. If your asset falls and you're not able to reposition in front of it, and then you get stuck with the shares and the shares go down. So that's an important part, is making sure the asset that you buy. But with selling options, puts and calls, you can consistently win over time.